Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis. A warm welcome to Money Talk for the final time this week and ahead of a long holiday weekend here in Hong Kong, also in mainland China as well. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the European Central Bank has delivered a hawkish interest rate cut, reducing its main interest rate by 25 basis points from an all-time high of 4% to 3.75%, but it warned that future reductions would depend on price pressures easing further. And the ECB becomes the second G7 central bank to cut interest rates this cycle, after the Bank of Canada reduced its official lending rate earlier this week. Initial jobless claims in the US, which are a proxy for job cuts, rose more than expected last week, and labour costs in the first quarter were revised lower, echoing data in recent days that have shown signs of the labour market softening. The number of people claiming unemployment benefits in the US jumped by 8,000 to 229,000 in the week ending 1st of June. That was above economists' expectations of 220,000, and it was the highest level since early May. Outstanding claims unexpectedly rose to almost 1.8 million in the earlier week, the highest in 7 weeks. India's Prime Minister Narendra Modi said he was looking forward to closer ties with Taiwan after he secured a third term in office. Tony's President William Lai congratulated Mr Modi on X for his third straight election victory and touted the fast-growing India-Taiwan partnership that will contribute to the peace and prosperity in the Indo-Pacific. In response, Mr Modi wrote on X, "I look forward to closer ties as we work towards mutually beneficial economic and technological partnerships." And Taiwan led Asian markets higher, with the Taiwan-weighted index surging almost 2%. Shares of index heavyweight Taiwan Semiconductor Manufacturing Company, the world's biggest chip foundry, rose 4.7% to an all-time high, boosted by the surge in the Nvidia's share price in New York. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Sam Faveur, CEO at Mandarin Capital. And with a view from Australia is Toby Lawson, the CEO at Statton Partners. If you want to get in touch or read my daily Asian newsletter, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Thursday, the S&P 500 and Nasdaq composites slipped from their record highs reached on Wednesday, led lower by chip designer Nvidia, with investors also in a wait-and-see mode ahead of the jobs reports later today. The S&P 500 was almost unchanged at 5,353 after hitting an all-time intraday high earlier in the day. The Nasdaq composite inched lower by 0.1% to 17,173. The Dow rose 79 points, that's 0.2%, to finish the session at 38,886. Shares of Nvidia closed 1.2% lower, sending its market cap back below the $3 trillion mark to $2.976 trillion. Nvidia became the third US company to close with a $3 trillion valuation on Wednesday and overtook Apple as the world's second most valuable company. It did fall back behind Apple today after the pullback that we saw. US government bond markets were quiet ahead of the hotly anticipated payrolls data later today. The yield on the benchmark 10-year Treasury inched up 1 basis point at 4.29%, while the interest rate sensitive 2-year yield was unchanged at 4.73%. The US dollar index was 0.2% lower at the 104.1 mark. The yen moved 1/3% higher to 153.63 yen as Bank of Japan Governor Ueda said inflation expectations must accelerate to 2% and stay there. And he added the central bank will proceed cautiously on rates. The offshore Chinese yuan stabilised around 7.26 renminbi per dollar after a brief increase earlier in the day. Gold continued its rally as 2 G7 central banks cut rates this week. The precious metal settled 0.8% firmer at $2,373 an ounce following the rate cuts from the Bank of Canada and the ECB. Brent crude oil futures climbed almost 2% to $79.87 per barrel on Thursday, and cryptocurrencies were weaker despite the return of the interest rate easing cycle this week. Bitcoin fell almost 1% to around $70,600. Hong Kong stocks were boosted by record high closes for the S&P 500 and Nasdaq composites the previous evening. The Hang Seng Index rose 52 points, a third of a percent, to 18,477. The Hang Seng Index has gained 2.2% so far this week and is on track to end a 2-week losing streak. On the mainland, the Shanghai Composites, that fell 0.5% to 3,049, ahead of Chinese trade data due later today. And futures markets pointing to an advance of about 80 points for the Hang Seng at the open, should start trading around 18,560. And you can get more details on the latest market movements in my daily newsletter, which is at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And let's welcome our Friday morning guests who are probably in holiday mood this morning. We've got a long weekend coming up here in Hong Kong for the Dragon Boat Racing Festival. We have with us, first of all, Francis Lun, who is the CEO of GEO Securities. Morning,
Hi,
Francis.
good morning.
And also with us is Sam Faveur, who is the CEO of Mandarin Capital. Plenty of CEOs this morning.
Good morning, Peter.
Let's start. There's an interesting debate, maybe debate's the right or the wrong word, an interesting spat going on about the future of Hong Kong, which has been taking place this week. It really started with Stephen Roach. You remember Stephen Roach? He was the former chairman of Morgan Stanley Asia and a US economist. He's been saying, he was at the Foreign Correspondents Club this week, and he was basically saying Hong Kong's economy is going to struggle to recover on its own without a rebound of the mainland Chinese economy, which he predicted was going to underperform for the foreseeable future. And he said it was important for the financial hub to allow for constructive criticism. That came because, you may remember, he wrote in February a piece called "It Pains to Say Me to Say Hong Kong is Over." That took place during the public consultation on the new national security legislation. He said that piece was so sensitive, he was then muzzled at the Chinese Development Forum in Beijing a month later. But it's basically was underlying the importance of trying to distinguish Hong Kong from China in order to try and sort of decouple itself a little bit from the poorly performing Chinese economy. Now, the government's hit back at that, saying that that's basically untenable, and it's cited a whole list of data proving that, or showing that Hong Kong was doing pretty well at the moment. We've also had people like Ray Dalio and Mark Mobius chime in with their thoughts as well. So let's dig a bit more into that. First of all, Francis, let's give me your thoughts. I mean, the basic tenet of what he's saying is the Chinese economy is going to slow for a considerable period of time. Hong Kong needs to emphasise what makes it different from mainland China. What do you say about that?
Well, I think that's true. I think China has emerged from a poor country into a mid-level plus country now. The average GDP is about $10,000. That's about income. I think from that level you grow to 20,000 takes a considerable leap. You have to improve your industry and everything in between. The only thing China is not behind the world is infrastructure building. I think China has very good infrastructure, but then the export is not growing as rapidly as before. I think this is where China has to improve in order to get to the 20,000 US dollar average GDP. But it's true that in 2007, China is growing by something like 10% a year. Now, in recent years, growth rate has been slowed down to 5%. But still, it's still better than the U.S. and Japan and other countries. But it's not as good as before. And that, of course, dragged down Hong Kong's growth rate. Hong Kong's growth rate used to be, 10%. Then down to 5%. In recent years, it's even worse than that because of the immigration crisis. We lost about 200,000 working age population. I think that counts a lot. I think the government's policy is right. We are trying to attract talent to Hong Kong, especially from China. And if Hong Kong's population stabilizes or starts to grow, I think Hong Kong can rebound. I don't think I share the pessimism of Steve Roach.
So he's saying that the mainland Chinese economy is going to underperform for several years. You think that's being too pessimistic? Or maybe it will, but that doesn't mean to say Hong Kong will do the same.
It won't be the 8% as several years ago. I think you should be satisfied with 5 to 6%. I think when your standard of living go to that mid-income level, you expect a slowdown.
Sam, what are your thoughts?
So I think it's a bit different between China and Hong Kong. About the structural underperformance, the future of China, I actually agree with Steve Roach on the fact that you had this 20 plus years of cycle, which is investment driven. And what we're seeing a lot across the sectors is you have overcapacity, whether you're looking at electric cars or you're looking at construction. You are in a situation now where in China you have overcapacity, and that has drained a lot of the resources, and I think that will be a drag in the foreseeable future. So whether it's 10%, 5%, at the end of the day, we're not really completely sure about the numbers anyway. But most importantly, beyond the number is the quality of growth and the fact that the Chinese economy has to transition from this investment cycle, which is coming to an end. As Francis said, the infrastructure is the best in the world, but you can only construct so many airports. So now you need to do something. Too many roads. Yeah. So that's overcapacity. So you have to deal with that. And that's, if history is any guide, and you look at Japan, that is going to take time to absorb this overcapacity. Mm-hmm. So that's, to me, is a big problem. And that is going to be a drag on the economy and this transition phase, which could last for a very long time, knowing that China is going to face the similar problem that Japan did, which is a shrinking working population. So that is the structural things they have to face. And that basis, I completely agree with Steve Roach. Now, specifically with Hong Kong, it's a bit of a schizophrenic situation, because if you want to maintain your specificities, which Hong Kong was really international, then you still have to make it significantly different track to attract by the international talent, but the one which are the Westerners when you want to bridge with China. If you attract the talents from China, you're making it you absorb really Hong Kong within China, which is not necessarily a bad thing, but it's a policy issue. Now, for attracting the Westerners back, you can throw all the numbers you want in the planet. That's not the problem with the Western. It's a trust issue, and some of the values which the Westerns want to see in Hong Kong, which are not there. So and again, I think it also goes against this GBA integration. If you want to integrate, by definition, you are going to change things and you are going to make it more alike in all senses. So I don't think you're going to see Hong Kong as it was before as an international city. It will be different. Now, what China wants to make of Hong Kong, do they need it as an international financial hub? It was before, I'm not sure, because China has a lot of other ways to open its capital markets and make it as a financial power. So Hong Kong has to find its place within the current environment. Whether it can be the same as before, I actually don't think so.
Well, Stephen Roach, what he says on that is that the United States has become reluctant to distinguish between Hong Kong and the mainland. He says that's partly due to what he calls the clearly altered political climate since the protests in 2009. And what he says is, I implore all of you who want to stand up for Hong Kong, the best thing you can do is stand up for the distinction that makes the city special, to make the case that you are not just another Chinese city. So what do you say about that? Well,
that's difficult to do in the current political climate. You have the National Security Act, and then you have Article 23. And how can you make Hong Kong distinct from mainland China? I think in the eyes of the foreign countries, I don't think there's any distinction. I think the problem, what I heard from industrialists, that American importers view Hong Kong companies as Chinese companies, so they don't place orders with Hong Kong companies. That is why the port suffers a drastic decline in the past year. because of the decline in export orders.
Well, yeah, I think the political climate sums it all. I mean, if you see what happened for 4th of June, celebration now versus 4 years ago, it's pretty clear there has been a drastic change. And this makes all the cases for the external people to say China has taken over politically, and then eventually as a economic plan, Hong Kong. So I think it would actually be probably even better if China says, this is what I want from Hong Kong, this is the roadmap, and it will be a lot of clarity. I think one of the biggest problems you have at the moment is we want to be specific, we want to have this specificity, but it's not defined by the government per se, and even by the Beijing government say, we want to leave Hong Kong as governed by itself. So I think this is the uncertainty which is creating the most problems. If people knew the rules exactly and what will be the future in the next 10 years, I think it will be a lot easier.
Now, the Hong Kong government has hit back in a statement. It's called out what it called criticism by some individuals. It didn't name anyone, but clearly it was referring to Stephen Roach. It said basically his comments were completely at odds with real data and facts, and it said in the statements that it wanted to set the record straight, saying China's real economic growth rates in the first quarter and for all of 2023 were both above 5%, ranking it among the fastest growing major economies in the world. It also quoted an IMF study which had concluded that the mainland economy contributed to more than 30% of global economic growth. And the government also said Hong Kong was growing steadily, increasing by 3.3% in 2023 and achieving year-on-year real GDP growth of 2.7%. And it says it was estimated to grow this year by 2.5% to 3.5%. Now, of course, that data is all correct, but does it sort of miss the point, maybe?
Yeah, I think it's a fact that the growth in Hong Kong has slowed down. It used to be 5%, now it's 3%. So, and when you go out at night after 8 o'clock, you don't see anybody in the restaurants. That is a fact.
Well, one piece of data the government didn't mention, but which came out this week, is that retail sales in Hong Kong plummeted almost 15% in April. Yeah. And if you take into account inflation in volume terms, retail sales fell 16.5% year on year. Now, they're big numbers, aren't they, which suggests not just a cyclical issue. This is not just about base effects or seasonal effects. There's a real structural issue going on that Hong Kong needs to address.
Yeah, I think half the population now go to Shenzhen for food and shopping. I think that caused a sharp drop in retail sales in Hong Kong. That has to be one of the major reasons.
And also immigration. I think a lot of people have left, so as you mentioned, so that's another factor. I think you can't really regain trust by throwing numbers, because if you look at China growth, for instance, you could oppose the youth unemployment. If you look at Hong Kong stock performance over 30 years versus the S&P, I mean, it's dire. So I don't think people want to look at numbers. They want to see real concrete actions plan and what you're going to do to bring this confidence forward, because I think in Hong Kong it's really a crisis of confidence.
And how should the government address that? What can it do?
First of all, it needs to address it with its domestic population, because at the current moment, I'm not really completely in Hong Kong, but I feel the mood is very depressed. So first of all, if you see this in the retail sales, that means the people are not going out, and that's the first thing they need to address. Restaurants closing, that's obviously depressing people. They don't go out, and the mood is not there. So you need to address first and foremost your domestic population and bring back the trust of your own population.
Well, a few other people have chipped in. First of all, Ray Dalio. He was speaking, hedge fund billionaire Ray Dalio, I should mention. He was at the Greenwich Economic Forum this week, which was taking place in the Connect Hall, the Hong Kong Exchange Connect Hall. I was there, so I heard him speak by video from New York. He's the founder of Bridgewater Associates. He basically said this. He said Chinese assets are very attractively priced. He said diversification and investment in China is desirable. He said there are concerns among individual international investors about potentially being penalised by their governments for investing in the country, with anti-China policies set to gain bipartisan support in the US this year. And he said China's own economic problems, including its real estate crisis, debt issues, and the knock-on effects of those, are making investors anxious. But he says none of those risks outweigh the potential benefits of investing in China, in his view. He says there are certainly effective ways to make investments in China despite the challenges, and he says Bridgewater has done very well over the last 5 years operating there, he said.
Well, but most American funds basically have left China during the past 2 years. That Biden said, I don't want American money to be invested in China. And then you had the exodus of U.S. money from shares like China Mobile and then the Sinuk and PetroChina, things like that. And then that's followed by European money. I don't think they have returned yet. You have the downsizing of overseas investment banks in Hong Kong. That's actually finance is one of the sectors that are not doing very well at the moment.
So despite the rebound in the market, foreign investors, you say, are still not coming back.
Most of them have not come back.
Again, I think it's a trust issue, and I don't think the foreign investor will come back in size until there is real proof that we have a functioning market and not too much intervention, because you have this intervention risk. I mean, Bridgewater is a bit of special situations, place, and I think he's also talking his own book, so it's a bit of a different one. But of course, you can make money in China if you do special case situation. But in general, I mean, there has been intervention, and the playing field is unequal between the foreign investors and the domestic investors. Whether it's on the legal side, which is addressed. I mean, it's addressed progressively in IP side or bankruptcy side. But again, there's still a long way before you have a domestic market which is on par with the international markets.
Now, someone else has chimed in. Mark Mobius. He's the veteran emerging markets investor. He's turned bullish on China, actually, and what he says Hong Kong needs to do to take better advantage of its strengths to retain its competitive edge, or he says that Hong Kong needs to take better advantage of its strengths to retain its competitive edge. He says he believes China's recent property support measures are going to restore confidence. And you have to remember, about a month ago, he wasn't bullish at all. He said Chinese equities only a month ago were not attractive. He says now is not a Super Bowl, but he thinks things are beginning to look good now. And he also wrote in a blog post yesterday an article which was called Hong Kong Far From Over. And he said, if you don't move with the times, you risk getting left behind. He said Hong Kong must reinvent itself and make better use of the strengths it's cultivated over the years. He said it was clear from his trip to Hong Kong that the fundamental spirit of Hong Kong's business environment is still very much alive. He says from an investment perspective, never a good idea to write off the potential of any city or any country, and no market is ever really out of the game. So thoughts on that, first of all?
Yeah, I think he's right in this respect. I think despite the sanctions and everything else, China's economic growth showed surprising strength this year. Exports are growing again, despite a lot of the manufacturing activities have been switched to India or Vietnam. But exports are growing. So I think there's a fundamental change. I think still the Chinese are overcoming adversity, and then the economy is growing despite the falling population. It's not as good as like 5 years ago, but it's not going downhill.
I think it depends. If you look at business opportunity, financial opportunities, because financial investment is very different from business opportunity on domestic market when you extract. At the end of the day, if you look at those markets, emerging markets, for the last 30 years, it has massively underperformed a market like the S&P. And so I don't think it's about the growth of the economy, it's about the return on equity. And it is something which is very different approach between the economies and the shareholders in this region and the Western world. And even if you have 5% growth, but this growth is not passed on to the shareholders, you're never going to have an outperforming investment gain. And I think that's the big difference. So, and I think this is structural. And that's it. I don't see how these markets can actually outperform on the long term. You can have obviously cycles where they do very well, but on the long term they will always underperform because the priority is not the return of equity. It is usually, given the business structure, is the business are structured, the wealth, the accumulation of wealth, a certain group of shareholders, which is not everybody. And that's the big problem of the Asian markets.
As in all these comments, there's a little bit of a mixing of two issues, isn't there? The first one is what should Hong Kong be doing? And then the second one is China a good investment right now? Well, China could be a good investment, but that still doesn't change the fact that Hong Kong needs to have a bit of a rethink, would you say?
Absolutely, and I think and there's also what you're saying is the macro side and the micro side. You can have very good investments individually in China. If you do your homework, you'll do very well. But as a whole, I think there's a structural issue. And again, for Hong Kong, if you're looking purely as Hong Kong as a financial center, I don't think it's enough. Now, they have to find something else for the city. And that's why it has to reinvent itself.
One of the things he said that Hong Kong could do is he says, I believe Hong Kong would stand to benefit significantly by embracing technology and AI to align with China's ambitious plans and to solidify its role as China's bridge to the world. Now, of course, the only thing I wonder about that is I thought that was our plan, to embrace technology, become an INT hub. In the last few budgets, we've had a lot of money spent on it, haven't we?
But the problems, America would severely restrict the exports of chips to Hong Kong and China. We cannot buy NVIDIA chips.
Right, so that's hindering our ability to be an INT.
So the development of artificial intelligence in Hong Kong and China will be severely limited when you cannot buy the state-of-art chips.
But it hasn't stopped Shenzhen being an INT hub, has it? I mean, that's clearly regarded as a...
But if you look at the AI products, they are not up to par with Americans or even Taiwanese, frankly.
So I think on the technology, there's this severe restriction on China, for China for the semiconductors, but I think eventually they will invest and they will catch up and also differentiate. You saw it in the internet world. They had leaders versus the West. I think they just missed the boat, actually. They just were focused on the other side and they didn't see it coming. And that's the difference between a bottom economy where the US have and just seizing opportunities on the ground and the planned economy. So I think on this one it will catch up. But I think from Hong Kong side, there's plenty of things which can be done. They have some of the top universities in the world. They could be a science center. They could be an education center. They could attract people. Common language is still the English for this. There's a lot of things which can be done on that side. Also tourism. I mean, it's a great place, Hong Kong, for a lot of things. So it has other things beyond just this bridge to China, where Hong Kong can, by itself, define its position. And I think education is a really good one. Top infrastructures in Hong Kong.
We were voted, I think, in the top 3 of our universities were voted in the top 20 universities in the world in a recent survey.
Yeah, that's right.
If I look at just the dental world, which I'm working on at the moment, Prince Philip School is the second in the world. I'm not sure anyone in Hong Kong knows that. They should be proud of it.
Okay, that's interesting. I mean, I suppose what is interesting, we've heard here what various people think, like Stephen Roach and Mark Mobius and Ray Dalio. We've also heard what the Hong Kong government thinks. I'm wondering, what does Beijing think that Hong Kong needs to do? And there are signs. I mean, Beijing has sent out hints that Hong Kong does need to rethink its approach, hasn't it? I mean, Zhao Balong, the director of the Hong Kong and Macau Affairs Office, he said in April the city needed to solve its problems using new thinking, new methods and new routes. So I would sort of take that as maybe Beijing itself is saying, Hong Kong's got to have a bit of a rethink.
Well, they said that they're going to let the top companies in China to list in Hong Kong, but so far we haven't seen them. Like Shanghai Motor or Amperex.
But Chinese companies are not listing anywhere really at the moment, are they? That's part of the problem.
If you look at Shein, Americans are certainly not putting out their welcome mat.
Yeah, no, it's, anyway, that's not going to redefine Hong Kong. But I think Hong Kong is a hot potato for Beijing, so they're waiting for proposal from this government. And so far, it's like one is watching the other. And again, they really need to look domestically. What has the main assets of Hong Kong? What does the domestic population really want? And from there, they can build up, because they're still going to rebuild Hong Kong on its domestic base.
One of the things that Stephen Roach was saying was that there's not enough sort of entrepreneurial spirits, and particularly sort of thinking from the government. There wasn't really any novel thinking from the government at all. And he says that's because the politics and influence that Beijing has had in shaping the politics here don't really lend people to think in an independent way and come up with independent policy initiatives that could make a difference to the economy.
Well, that hasn't really changed for the past 30 years. Hong Kong is not known for a hub of incubating new technology companies. Hong Kong has never been a new technology center.
Well, he says that the government here doesn't have the right political environment to really come up with ideas to reverse the city's fortunes. Now, I'm sure the government would disagree with that, but Sam, what do you say to that?
Well, I don't think it really matters. I think Hong Kong has always been from the ground, and the entrepreneurs have always been for the ground, and they never really relied on governments. It's never been the strongest government, the strongest place in the region. If you wanted to get help from the government, if you look at even the big Chinese firms like Tencent or DJI, they all originated from Hong Kong, and people found their way to develop them. So I think that's probably an unfair comment, because nothing has really changed in Hong Kong. It's all down to the individual's initiative.
I mean, that's always been the way Hong Kong has worked, hasn't it? It's been a laissez-faire economy, low taxes, as little as possible regulation, but the government doesn't try and dictate what areas companies should invest in, and maybe that's where it's going wrong. It's trying too much at the moment to pick winners and losers, sectors that it thinks should be doing well and invested in. Wouldn't it be better to go back to the old Hong Kong and let the market decide? If companies want to invest in certain areas or certain technologies, they'll do it. They don't need to be told by the government that's what they should do.
But they've been blamed for being too laissez-faire. They've been blamed for not getting involved and not boosting small companies. So they are trying to do the reverse, trying to get involved in the economy, try to boost economic growth.
But isn't that a mistake, maybe? Isn't that a mistake? Because that's never been really the Hong Kong way, is it? Hong Kong's done very well by not having the government interfering too much.
It's certainly a problem of too much intervention, because you also need to have natural selection of what is the best companies and the best technologies out there. So whenever you start putting too much intervention, put too much capital from the top, then you might actually continue to invest in things which are not worth it. So it's always a trade-off. I think it worked very well for 100 years, so there's no reason to re-step in. And I don't think people in Hong Kong, if they want to be entrepreneur, they will independently from the government anyway.
Let's, just before we finish, get your comments on a bit of economic news. The European Central Bank has delivered what's known as a hawkish interest rate cut. Cut interest rates by 25 basis points to 3.75%. They were at an all-time high of 4%, but they have warned that future reductions are going to depend on price pressures easing further. Some people had been suggesting that this would be the first of maybe a couple interest rate cuts over the summer, but the ECB seems to be ruling that out. It's also worth noting that the Bank of Canada has also reduced rates this week. So we've now had, for the first time this cycle, 2 G7 central banks now cutting rates. So is this the beginning now of the rate cutting cycle?
Well, I hope so. That will give a boost to the stock markets, and also that will ease the pressure on the renminbi, which has been falling against the US dollar.
I don't think so. I think it's I think the central banks had it wrong for the last 3 years. We still have numbers coming out higher than expected, and I actually think it's just a political side. And because we have European elections also coming this weekend, so I don't.
So you think this was a mistake?
I think so, yeah. I think the central banks across the world actually have been very, very bad at managing this cycle. And inflation, I think we're seeing inflation staying high and growth going down, so it's a situation of stagflation. And in this kind of situation, you cannot really decrease rates. And the sooner the governments see that, I think the better.
Well, there was one dissenter on the governing council. It's Robert Holtzmann, who is the head of the Austrian central bank. He said rate cut was inconsistent with the recent rises in inflation and wage growth in the Eurozone. He said database decisions should be database decisions. Sounds like you agree with him.
Absolutely, 100% right.
But what about the Fed? Where they're going to meet next week?
Yeah, I don't think they will cut interest rate next week because inflation is still between 3 and 4%. Their target is 2%. So you need to bring down inflation to 3%.
Hasn't stopped the ECB though, has it?
Well, it's 25 basis points. It's just symbolic, and I think it's linked to the elections coming. But it's definitely not database. Yeah, I completely agree with the Austrian representative.
But if you look at the data is showing now in the US that the jobs market is weakening, isn't it? We're certainly seeing now some fairly consistent data showing a slowdown. Although, I suppose, despite the slowdown, I mean, the jobs market is still fairly robust, isn't it? It's not like collapsing. It's just slowing down, which is perhaps what the Fed wants.
Yeah, definitely.
And then it's also about price stability. So whether they will slow down will cause a stabilization of labor price. So again, that's the growth and the price, slightly different story. So let's see how the price reacts to that.
Okay. Well, look, thank you very much. We've had an interesting discussion this week to end the week. You heard there Francis Lun, who is the CEO of GEO Securities, Sam Faveur, who is the CEO of Mandarin Capital.
Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
Let's get your thoughts on India. India's a country you know well. You've lived there for a while. And, of course, the election this week, it turned out to be a bit of a shocker, didn't it?
Yeah, it was a surprise. And my first impression was that this is a great day for democracy, because when you think about the way the dominance of the BJP and the Modi government over the years has sort of sensed that it was inevitable that people would just roll them back in. There was a sort of rejection, particularly in some states where BJP was strong. Reflects strongly that governments need to be mindful of hubris and assuming that power is inevitable. So first impression for me was excellent for democracy and excellent for India in one way, notwithstanding the disruption it caused to the financial markets because of the shock of the result.
And particularly so, I suppose, when you consider that India is surrounded by countries which are patently undemocratic. You've got Afghanistan to the north that doesn't have elections at all, and then other countries around it that just blatantly rig and fix their elections. This is a beacon of light for democracy, really, isn't it, in the region?
Yeah, and I think that's what should be celebrated, Peter. The surprise itself, I mean, the government comes back in, I think is not a bad thing for India. I think the stable central government, I've argued this before, a strong central government's important for India as it goes through its growth phase. But notwithstanding that, it's important that, every person's vote counts, and more than 600 million people voted in India and gave a bit of a wake-up call to the national government to say you got to do better. And I think that's a good thing.
So what changes then as a result of this? Because Mr. Modi, in his sort of speech, he didn't even mention the fact that his party, didn't cross the threshold of, being able to rule on its own. He sort of just completely ignored that. Is he right to do so? Does anything change as a result of this? Because obviously his allies are still backing him, so we'll still have the National Democratic Alliance sort of running the country. Or does something change as a result of that, in that Modi maybe now has to be more consensual and more considerate in his policies?
I think it's a significant result, not so much in the short term, but in the long term for the next cycle, for the central government elections. The Congress Party and the India Alliance, they were, dead and buried, supposedly a year ago or even before. Their comeback sets it up for a big, 4-year cycle when Modi's most likely not going to be the candidate at the Prime Minister level. So that's going to be the most significant factor. More bringing it back into where it is now, there will be some shifts. There will be some horse trading at the cabinet level with some of the minor parties in order to get what they want. there will be a pivot towards maybe some more investment in trying to placate what appears to be the most antagonistic element of the rejection of the BJP was jobs and cost of living, things that are pretty normal that we're hearing all around the world, but particularly in some of the states where BJP felt that it had a sort of almost a monopoly power, got found out because of a lack of good jobs and a lack of support for cost of living. So I suspect that some of the spending might be shifted towards that, which may pull back a little bit of the high growth model. But looking at GDP, Peter, you're still around 7.8% to the March quarter. It's still one of the strongest growing economies in the world in terms of large economies. I think it'll be a bit of a blip in terms of that trend, but there will certainly be at the more local level a significant shift in how they go about getting voters back on side.
I suppose what investors are concerned about are the economic policies, aren't they? Which is why we've seen this volatility in Indian equities this week. But do you think, the strong economic policies, investing in infrastructure, trying to boost domestic demand, trying to increase jobs for all the young people, are they all still on track?
I think so, more or less. At the margin there'll be changes, but more broadly speaking, I think the growth model and the trajectory of the Indian economy continues. And you see the equity markets, they obviously reacted negatively, but they've recovered quite a fair bit of that move. But yes, I think investors and even foreign investors, which would be the most interesting, I think foreign investors were becoming more and more confident that this was a no-brainer to invest in Indian equities. And maybe that just shortens them up a little as they reflect a little bit on Modi's position and therefore the economic policies that India can pursue. But more broadly, I don't think a lot changes.
What did Mr. Modi do wrong? I mean, I've heard various theories. One of them is that it was the poor that sort of rose up and voted against him because although the economic growth has been good, it hasn't been spread out evenly. Not everyone in the country has benefited from it. Is there some truth in that? And what did he do wrong?
I think you could argue hubris from the BJP. Particularly in states where they would have assumed they would have done very well, like Uttar Pradesh, Rajasthan, and Madhya Pradesh up in the north where BJP had been very strong. They actually got rebutted quite strongly in some of those states. Of course, in West Bengal and Maharashtra, much more progressive governments, and they got belted there a little bit. And that reflects, as you quite rightly point out, I think the economic growth has been uneven in terms of who benefits, and this is not untrue for Western democracies around the world. That the growth has helped certain people and not all, and there seems to be a widening gap between rich and poor. So I think that's probably an underestimation of the impact of that in some of the states where they probably felt that they were rock solid behind the BJP. And so that'll be a wake-up call for them.
I mean, they say in India, don't they, that the road to government, the road to New Delhi, runs through Uttar Pradesh, which is the largest. Worth pointing out, it's the largest state in the country. If it was in India, if it was a country itself, it would be the fifth largest in the world. But they really rebutted him this time, didn't they? After voting for him quite solidly in the previous two elections.
Yeah, and they call it the saffron state, which is the colours of the BJP. So they definitely biggest surprise in Uttar Pradesh, and as you say, it's a huge impact on the overall Lok Sabha, which is the lower house in the Indian Parliament. That will certainly have some ramifications in terms of policy, particularly at the more, I guess, for those who are critical of the Hindu first or the nationalist approach of Modi. That seemed to be reflected most aggressively in Uttar Pradesh, and that might soften some of that, policy push or that rhetoric that seems to be driven. And you've got to give credit, I guess, as well to the opposition in terms of playing to that and becoming successful at it. So let's see. I think in the short term there'll be some horse trading and volatility around who gets in cabinet and policy formation, but more broadly, I think it's setting up for a fair contest in 4 years' time. And most importantly, that will be when Modi's unlikely to be the leader. He has been the main reason why the BJP have managed to stay in power for as long as they have.
And from a markets perspective, obviously we've seen a lot of volatility in the equity markets this week, a big collapse, then a big rebound. Are we going to see more of that, or are Indian equities, investment in Indian equities, is it still on track?
I think it's still on track, albeit it might be a little bumpy for a while. I mean, as I mentioned earlier, the GDP figures are still really strong. I think, on an annualised fiscal year basis, over 8%. One of the best growths in the world. The March quarter figure was 7.8, well above the 6% or so that they're expecting. Inflation is high, but is always high in India and manageable. We saw some moves in the bond markets that probably reflected some concerns. But, yeah, I suspect what will happen is that the foreign investment in India will maybe just shorten a little. But any dips, I suspect, in equity markets will be well met because underlying the economic outlook for India is still very strong.
Okay, well, let's get your thoughts also on some economic news from around the world. First of all, back home there in Australia, growth seems to have almost stalled in the first 3 months of the year. The Australian economy expanded 0.1% quarter on quarter in the first quarter. What's gone wrong?
I think it was always softening. I think the economic outlook for Australia was always one that was marginally positive. Interestingly, and again, we don't use this measure, but because of the huge amount of migrant growth in terms of immigration coming into the country, if you look at the per capita GDP, we're in recession, which is not a good look for Australia. The shrinking per head of population output is a function of that. Increase to population and also a decline in productivity. I think we've mentioned this before. One of the concerns for the Reserve Bank with regards to inflation and interest rates is that the unit cost of labour is going up, even if the economic activity is falling. And this means that it makes it more difficult, despite the lower growth figures, for the Reserve Bank to respond because inflation's still, at the core level above 4%. And this means that they're still on the potential of actually hiking rates, even though we're seeing such weak growth figures.
It was also noticeable, wasn't it? Household spending slowed, contributed just 0.2 percentage points to economic activity. That presumably is having a big effect as well.
Yeah, and the savings rate in amongst those data as well suggests that people are running down savings quite significantly. So not only is there less spending, but they're actually, they're drawing on less reserves, which we had post-pandemic. So a lot of that GDP surplus, if you will, that was sitting in as a result of the pandemic seems to have been exhausted. People are spending less. The problem, I think we mentioned it in last week's inflation figures in Australia, is that most of the cost rises are coming in consumer staples, where consumers have little choice to avoid spending: insurance, rent, food, transport. And that makes it a very tough job for both government and central bank to reduce inflation while at the same time keeping consumers spending.
Mm-hmm. But Michelle Bullock, the Reserve Bank of Australia governor, she's still saying very data dependent. She's not ruling anything in or anything out.
Yeah, one thing to note that they've got on the horizon as of 1 July, a big amount of tax cuts coming in, some energy rebates, so a quite big fiscal stimulus hitting the books. And will consumers spend that, or will they save that? On balance, the statistics would suggest they're going to spend most of it. That actually adds to pressures on underlying inflation. So the Reserve Bank is sitting there going, well, let's see how that plays out. Even if they don't believe that the fiscal stimulus is too expansionary, it may mean that they just have to keep an eye on the impact on the throughput in terms of price pressures, and therefore what they can do on interest rates. At the moment, our rates are still relatively low on a variable basis to the rest of the world, but I suspect the Reserve are on hold at best, probably not going to hike. But definitely not looking to cut anytime soon.
Well, the ECB has cut. It's delivered a hawkish interest rate cut. It reduced its main interest rate by 25 basis points to 3.75%, but it did warn that future reductions would depend on price pressures easing further. Now, what's interesting here, Toby, is that there have been some central banks this year around the world that have cut interest rates, like Sweden and Switzerland and Brazil. But this week, we've seen for the first time in this cycle, two G7 countries' economies cut their rates. The ECB and also the Bank of Canada did it earlier this week. So are we now at the beginning of the interest rate cutting cycle, or is there something special about these two central banks?
Well, let's see what the UK do, because they're probably going to follow in, I suspect, and cut rates. Yeah, hawkish cuts, an interesting expression. It's a tautology almost, yeah. They're looking at data dependency again. They mentioned that this was clearly a one-off until they can see more the data to determine where they go again. The market's predicting another one to two before the end of the year. Interestingly, the bond market reacted somewhat negatively. Yields were pushed up 6 to 8 basis points across most of the European countries. So that reflects probably that they took more of the hawkishness of the ECB announcement rather than the actual cut in rates, because it was well priced into the market. Bank of Canada probably similarly did, in terms of their commentary, said, look, don't take it as a trend. They're pulling back to 475 from 5%, data dependent again. And then, of course, we pivot to the US, where it's all going to be the one to watch. And the big data tonight is obviously the payrolls, to see where the labour market's at, to see if there's some sort of opportunity here to price in a Fed cut this year.
We are seeing the data we've seen so far, the ADP numbers. There is a definite slowing in the labour market now, isn't there?
Yeah, definitely. I think the jolts as well, yes. Earlier in the week.
Yeah, the job openings.
So you've had a couple of big bits of data push the September rate cut probability to 70% in the futures markets. Big one's obviously the payrolls number, where they're expecting about 190,000, 3.9% on the unemployment rate. Let's see how that goes. The other data that we saw during the week, some of it was pretty good, I thought. PMIs, both on the manufacturing and on the services side, were better than expected across some of the measurements. So that sort of feeling that the US economy is still trucking along pretty well. Post-corporate earnings in that first quarter earnings were pretty good. Forecasts are solid for the corporate sector. And employment's the one. I think that if the Federal Reserve can see a big sort of softening, or at least a stronger trend in regards to the labour market, that should push them towards a September or December rate cut.
Okay, well, Toby, thank you very much indeed. Enjoy the long weekend down there as well. I know you've got a holiday coming up also in Australia. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. There's no show on Monday, as it's a public holiday in Hong Kong and mainland China for the Dragon Boat Festival. I'll be back with another show on Tuesday. Joining me then will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Nick Marrow, Lead for Global Trade at the Economist Intelligence Unit, and in Washington, D.C., our US economics correspondent, writer and broadcaster, Barry Wood. Have a great holiday weekend.
Money Talk.